Alrighty, welcome back, Alpha Hunters. The markets are closed for the week of August the 2nd. It was a busy week. There was a lot going on this week, one of the busier weeks of the year, and we'll go through some of it. Mostly, we're going to go through it kind of quick. We'll talk a little bit about some of the more important things, but let's just kind of get it going here. Monday, not really too much kind of going on. Nice little gap up, kind of just pulled back pretty gradually into mid morning ish. Nice little pop midday. Kind of was just kind of trying to bounce around. And I guess let me stop right there and just say, if you remember kind of how we were going into this week, or what I was kind of talking about at the end of last week, and we'll look at this a little bit when we look at the daily picture for the Qs and the SPY. We were kind of talking a little bit about, expect a little bit more of a bounce on the SPY and the Qs. SPY kind of getting above some of the daily moving averages, and Qs maybe getting up to the top end of the daily moving averages that are coming down, maybe breaking just above them. So, with that in mind, I wasn't too surprised with some of the choppiness that we had early on in the week. And then we got to Tuesday, nice little pullback all the way in the middle part of the day. It's a nice little bounce off the lows, looking pretty good. We go into Wednesday, nice little gap up, and we just kind of rode higher. It was not too much kind of going on all that much going then into the Fed FOMC, kind of mid, that 2 o'clock Eastern time frame. But we had already gapped up pretty good. So when we tried to bounce during the FOMC time, we also had to sell down. I mean, we gapped up pretty large there on Wednesday. So we didn't end too indifferent from where we started the FOMC on Wednesday. So yeah, it is what it is. But we were starting to get breaching above on the Qs, at least up into those, the moving averages coming down and stuff like that. So we were starting to do that like Wednesday here towards the end of the day. Thursday, we gapped up 15 minutes, traded higher, and then it was on. Like, we kind of got to the areas, maybe the upper ends of the areas, kind of where I was, kind of talking about last week, maybe pretty good spots to be looking to be bearish if you wanted to play it that way. And then we just sold down for hours up until roughly the last hour of the day on Thursday. Nice little bounce off the low, somewhat decent. Thinking, okay, you know what? We didn't break the lows of the week. Possibly, maybe we continued to bounce. Well, Friday, we gapped down pretty good, and I'm going to talk about the economic data of why we gapped down, because there was some pretty good data throughout the whole week. Like, we had jolts on Tuesday. Like, we had data throughout the whole week, but Friday, this one wound up being the big one, because we got two jobs, or basically like two jobs data points, and we got non-farm payrolls that came in at 114K. The forecast was calling for 175K. It was a huge miss. The same time, we got another data point out. Unemployment rate jumped to 4.3%, up from 4.1% prior, and then the forecast is calling for 4.1% as well. So those data points did not do the market justice. Saw a nice little drop there to kind of start the day, and the market was already kind of trading down pre-market before we got those data points. But yeah, those data points did not help at all. Market opens lower, trades lower. SPY hit the 100 on the daily at the lows of the day here, and just tried to base out here. So yeah, that's kind of how it went. All right, let's take a look at sector performance for the week. Lower end of the week, tech, XLK, lower end of the week. Energies, also underperforming. Discretionaries, financials, industrials. Materials outperformed. Healthcare, staples, communications, all outperformed and positive for the week. Real estate and utilities at the higher end of the week. Utilities is actually up over 4% on the week. I wouldn't have thought that, but yeah, utilities did pretty well. So I'll just run through some of the companies that had, some of the bigger companies that had earnings this week. Microsoft, they did pretty well. A little bit lackluster, I think, on cloud growth from what I remember. But that was Tuesday after the bell, so that was a Wednesday trading day. We kind of had the reaction there. But you can see it's coming into the 200 daily moving average. Probably not the best spot to be bearish. Probably want to see how this thing sets up here over the next, week or two. See kind of what's going on there. Another one we got was AAPL. This was Thursday after the bell. This is one area that I think could be a pretty big risk, honestly, on the market, because of how much it has really been bullish for the previous 3 months, really, since last earnings cycle, right? It's done pretty well. It also had their AI event back in the middle of June. So if Apple's really starts to break down, which we haven't really seen it break down as hard as some of the other big tech companies, it has, but just not as much. This could be a pretty big problem for the market because a lot of people over the previous 3 months has priced in this whole new upgrade cycle with iPhone, AI iPhone type stuff, and I don't really know if the consumer would care that much about it. So, anyway, it's just something to kind of keep in mind. But it didn't really do have like a huge gap. It gapped up a little bit, but I mean Thursday's sell off was pretty substantial. It did trade higher. It actually broke Thursday's high, but it did trade back down. So you got a pretty large upper wick there on Friday. Be curious to see how this thing trades next week. It is under the 10 and 20 daily moving averages. Obviously, got a little bit of room to go to get to the 50, and then that would be a pretty interesting spot because we have a huge air pocket between the 50 and the 100, 200, kind of down at some of the lower levels. We also, Thursday after the bell, had Amazon. Amazon, nice gap up there on Thursday. It traded down, and then yeah, they got hit pretty good. So not looking great, especially when the gap down that large below the 200 moving average, and the fact that it wasn't able to rally and get closed over that 200 daily moving average. Oof. I don't know if I want to be bearish right here, right now, but yeah, that doesn't look good. I think if you're probably looking for like, maybe some shorter term type stuff over the next week, I'd be looking for maybe some bullishness, just because that is a pretty large gap. You also got a pretty large lower wick kind of coming in there on Amazon. AMD, this was another one that we had Tuesday after the bell, and it gapped up pretty good. I think they got a little bit of a bump from Intel. Intel's had some bad chips, and we'll talk about Intel next. And yeah, this one probably got a little bit of a bump, not from them executing so much, but from probably Intel having issues on the past couple of generations of their processor chips and other things like that. But you can see that it didn't really matter because they wound up selling down there Wednesday and Thursday, even Friday. A little bit of a sell down, but mostly just kind of a flat day compared to Wednesday, Thursday. So AMD is kind of an interesting spot because it's definitely well below these 200 moving averages, or the 200 daily moving averages, and the moving averages coming down. And you had this breakdown, and then on earnings, you had the retest into that 200 daily moving average. And that's kind of where it topped out there Wednesday morning, and it broke back down. Right, you can kind of see that little upper wick right into that 200 daily. That doesn't look great. And that's about where I'm going to leave it. It does not look great. We'll see what happens going forward. And one of the bigger shocking ones this week was Intel on Friday. My goodness. So kind of like what I just mentioned with AMD, Intel's had some issues with their processor chips. And in talking with a buddy of mine who's kind of follows the tech world a little bit more than what I do, he's basically saying like it's a real problem with some of the processors that are faulty. Like they just keep breaking. They apparently are going to issue a patch, but this is something that's been going on now for their 12. I think it really kind of started with their 13th gen, and they're currently on their 14th generation processor chips. And there's some issues even with the 12th generation, and I think they're about to go into their 15th generation processor chips sometime later this year. So, but he was kind of talking about like he's kind of used Intel a lot in building and making PCs and stuff like that, but he's kind of like, hey, this issue was enough to break brand loyalty because they've kind of swept it under the rug for so long and didn't address it. They said it was the motherboard manufacturer, it was their issue, but it wound up, no, it's an Intel issue, and they kept denying it for the longest time. So you kind of wonder if this finally has come to head, because over the past quarter, there's been a lot of, really been over the past 2 quarters, there's been a lot of people kind of call this out now and say, no, this is an Intel issue, because it doesn't look great, and you get a huge gap down. And the other thing that kind of came out from their earnings is they are no longer doing a dividend. You see dividend back over here in May, dividend back here over here in February. There's no dividend coming here in August. So they have done away with their dividend, which they probably should. They need to focus on just, their business. They need to focus on their business. But if I zoom out here, kind of the levels that we've gotten to here on Intel is going all the way back to about 2015. This quick little drop that we had back here. And whew, man, I don't know. That's about the best I can say. I don't know. I mean, we got this top that we had back in 2012 and kind of like 2014. That's kind of where we pulled to back in 2015. So maybe it's kind of where we're pulling to now, and maybe not a bad shot to take it bullish or try to build a position. I don't know. I don't like it when a company's like they're having issues. You know, they've had a lot of competition come in over the past decade. They've been losing business. They keep having issues. This is not the first time that they've had issues with chips, and so yeah, I don't know. I mean, that's up to you. I can understand trying to take a shot here on Intel. I just wouldn't. I don't think I would be like all in on the portfolio. The VIX. Well, for most of the week, we did see the VIX kind of just pull back very steady until we got to really Thursday. And one of the things that we were kind of calling out Thursday morning on the live stream was kind of a little flag pattern that was coming in here on the VIX. And sure enough, by the end of the day, Thursday, like we were starting to breach higher that flag. And then yeah, look at that explosion off the top there on the VIX. So yeah, we definitely was VIX. You know, it seemed like it was definitely just a flag pattern. We just exploded higher. So the question is are we going to continue higher in the next week? Man, I really doubt it. I just kind of doubt it. I think we had such a strong move, especially on Friday, that I would at least expect some consolidation. So just maybe some pullback, maybe some consolidation. It doesn't have to like drop all the way back down to the lower teen area, but I would expect it to at least come back down a little bit while the market probably bounces. DXY, with the data that we got Friday morning, definitely the dollar dropped off pretty substantially, nicely breaking lower of some of the support levels that we've had over the previous couple of months. So we're not back down to the yearly lows yet, but there's not much in between where we currently are now in the DXY and those yearly lows. So yeah, I'd expect us to be moving down there probably into the lower March, maybe down to the lower January numbers. So anywhere between like the 102 mid area down to like 102 makes some sense. Probably just not going to be a straight line like we did on Friday though. GLD Gold Trust. Yeah, we got a nice little bounce here early in the week. I like the pullback that we had on Friday. Or, kind of looks like a double top, right? But it just could just be a quick pullback into the moving averages and grab some support and continue to push higher. I like still the game plan of just being bullish on any kind of pullbacks here. Yields. Talked about yields on the live stream on Friday, and I'm not one that think yields are going to go substantially lower, kind of like how we came out of the COVID drop off on yields. I'm not. Other people that we were talking to in the chat today think that it's possible that we go lower. Not to say that we haven't been at those lower levels before in history, especially with how much we broke down on Friday. But I mean, I'd be willing to say that going back down to definitely 1.5 and lower is probably out of the question. I have a hard time thinking we get below 3% myself. I think this little support level that we did put in around 3.5, 3.4% would be a pretty strong one for us to break through if we wind up breaking through that. But we could also just be chopping sideways on the yields here for a good period of time. So I'm kind of indifferent here, and to be pretty honest, the only thing I would really want to do with bonds right now is buying short-term, like 6-month bonds, and just holding it to maturity, and then just redoing and just refreshing that. That's the only thing I would want to do on bonds right now, and I think that probably be what I would want to do, just period. That means, yeah, kind of like just pulling it back out of the stock market and just buying 6-month bonds. And that was something I've been kind of talking with some friends and people over the past couple of months. Is like, dude, I think I would just rather just be in bonds, short-term bonds, 3 to 6 months, see what happens with the market. If it does show signs of like, yeah, we're substantially pulling back, keep doing the short-term 3 to 6 month bond bond thing. Don't worry about the trading price or anything like that. Just hold bonds to the maturity, collect your premium, and then do it again until the market shows you you're at a price that you're willing to go out of bonds and back into stock. All right, take a look at 10 and 2 inversion. Yeah, with the move that we had on the jobs data that we had on Friday morning, you see the 10 and 2 really skyrocketed higher. And really, that was the 2-year really dropped off very hard on Friday. I know we just looked at the 10-year. The 30-year didn't drop off as much, but the 2-year dropped off quite a bit, which is why this thing really is pushing higher. So if we get into a time period, let me turn off log here. If we get into a period in which there's no other real tops between kind of where we are now, because Friday we pushed up so hard, and the zero line is not that far away now. So I mean, it is very possible here over this next week the 10 and 2 uninverts and it gets back to positive. Typically in market history, and this is why this is very important to listen to and to understand, that is when you start to see the biggest market sell-offs. That is when you start to see the biggest market sell-offs. I went ahead and added in the SPX here, and you see as we uninverted back, what was this, January, like 2001, right? Once we uninverted from this time period, we were inverted, we became uninverted, and you can see the SPX had much more substantial downside. Same thing here back in 2006, 2007. Yield curve uninverts, we kind of top out in the market and we start to roll over quite substantially. There you go. It's a little bit easier to see that little drop that we had there in the 90s. So yeah, it is one that this is going to go down as one of the longest inversions in history that we are going to come out of. And the data says the longer the inversion that happens, the worse the market kind of downturn is. All right, taking a look at the HYG high yield corporate bonds, and yeah, nice little pullback there Thursday, Friday. Now they did pay dividend Thursday, so most of the reduction or price drop that they had on Thursday was due to a dividend. Other than that, I mean, Friday kind of continued lower. Might just be pulling back into the 7750 area and might continue to bounce higher. It did get above 7850. It took a while to kind of get there, but that was the kind of number I wanted to see it get above back here in this initial run. It took a little bit longer, like 3 extra weeks to kind of get and close over that 7850 level. And it could have just been a false breakout kind of number and just kind of pulling back. We'll see if that's just false breakout or pullback. I think this next week will probably be a pretty good indication. The LQD TLT kind of both look the same as far as this week goes. I mean, they both went straight up. Yeah, it looks pretty good. Kind of gonna come into basically the highs of ever since December. I mean, pretty close to that, and it's also the highs of 2024 that we had back in like January, February. So we're getting close to those highs, and yeah, it's done pretty good. I mean, yields dropped off pretty substantially all week, so there you go. LQD doing pretty good. TLT also looking pretty good. I am not one that trades bonds. There's a lot that kind of goes into bond trading on the yield side and paying attention to a lot of different data points. I mostly just use bonds to say if I don't want to be in stocks, I just go buy short-term bonds, and kind of like what I was talking about earlier. But yeah, I mean, there's definitely not much headway ahead. I mean, it looks like we could have just put in one really nice basic pattern over the previous 6-7 months. Doesn't look too bad, and maybe we are off to the races higher. All right, the IYT, the transportation ETF, it was looking pretty good for most of the week, and then we got to that Thursday, Friday, man. That Thursday sell-off was pretty nasty, and then Friday got below these lows back in June. So June lows. Yeah, that doesn't look great, and it makes sense on Friday because we got that the economic data, the jobs data that we got Friday morning. The RSP was looking really solid Thursday, Wednesday, I guess, really Wednesday. But Thursday, Friday came right back down. We made a little bit of a new high there on Wednesday, but yeah, that pullback there on Thursday, Friday just does not look great. I think it pulled into the 100 daily moving average there. I wouldn't be surprised if these guys, if we see a lot of chop this next week, even here on the RSP, I just wouldn't be surprised if we see some choppiness as we're pulling into some pretty significant long-term moving averages. So that'd probably be what I say for a lot of these, especially here, even on the DIA. DIA pulled back pretty strong there Thursday, Friday. It made lower highs, which the DIA has actually been holding up pretty good. And it didn't quite make it to that 100 moving average, but it did close above that 50 EMA by the end of the day on Friday. So maybe we'll just see some choppiness. IWM, nice little gap down there on Friday with the jobs data that we got. And we try to continue higher Wednesday. Huge upper wick. Kind of talked about that on Thursday. The look of that upper wick by the end of the day, just not great. And then you see the immediate reversal fall through Wednesday or Thursday and Friday. So yeah, it's just did not look good. It could have been a very snappy pullback retest into the previous yearly highs, because that is where we pulled to. Doesn't look great though. The Qs had a very significant move on Friday, mostly just because it gapped below the past 2 weeks of lows and below that 100 daily moving average. So there's not much between where we are now in the Qs and that 200 daily moving average. We are sitting right on top of the highs that we had back in like Q1 kind of time frame. So yeah, interesting look here on the Qs. Could continue to see sell-offs come, and same thing here with the SPY though. Even though that we just pulled into that 100 daily moving average, so I would expect at least some bounce. Try to bounce. People try to buy the dip off the 100. It's been a little while since we actually interacted with the 100, and it just kind of makes sense that we see maybe a couple days of consolidation before we push lower. But if we immediately move lower, especially if we close below the low that we put in on Friday, I mean, we're probably just going to keep dropping. And then at that point in time, I think you're just going to watch for the Qs to come down and hit that 200 moving average. I think that'll be the next thing that people probably watch the most. And one of the things that I'm going to throw this in here, I'm not going to talk a lot about this a long time because this is kind of theoretical and can go on for a while. But I think one of the things that's kind of going on right now, and one of the things I've kind of been talking to some friends over the past couple of weeks or months, really, I think we are getting to the end of the computerization era. Kind of like how we got to the end of the industrial era, industrial revolution era back in, the end of the 1920s. And when that happened, obviously we all know the Great Depression that then followed. It's not like we didn't continue to make industrial machinery and stuff like that, but the thing I'm going to say and what the similarities are like is back then in the 20s, everything was becoming motorized, everything was becoming industrialized, and once it started to just become everything was industrialized and motorized, and kind of machine driven, then it's kind of like you didn't have any of the extra rooms to grow, any of the extra room of growth. And once you kind of fully saturate the market and you kind of blow it out like that, the fastest you can grow is however fast the economy grows. And it kind of seems like we are at that kind of a point. Like tech, it is everywhere. It's like everything we buy has technology in it. Like almost everything. It's crazy. It's not crazy. I mean, it's just kind of the way it goes. But it is crazy to see how much things have changed over the past couple of decades and where we are with stuff. And so are we end of the computerization era? It's very possible. I mean, it's very possible because there's not much more room that software and hardware technology companies can really grow. I mean, everything's IoT. Remember, like 10 years ago, the next great revolution, next great bull market is going to be IoT, Internet of Things. Everything. I remember hearing about that everywhere. Then you stopped hearing about that like 5 years ago because, it was happening. It was like everything was being connected to the cloud and the internet and stuff. And software development with AI has kind of gotten commoditized. And is it perfect? No, but it's going to continue to get better. And I'm not saying that in the 20s, late 20s, 30s, that we were making the best machinery ever. And that's not true. Really, even in the Industrial Revolution, farming didn't even really get impacted until I would say really the 30s and 40s. I would say really the 30s and 40s. And but that was after that. But that was after the fact of a good majority of the Industrial Revolution. So there are things that are going to continue to get better. But I think for as much as growth that the tech companies can do, I think that is massively limited. I think that's going to be hugely limited. And I think we'll probably see probably just a deleveraging, but that's just theoretical. I don't want to go down the rabbit hole of that. I just kind of like some high level ideas, high level thoughts. Anyways, Alpha Hunters, expect some consolidation. At least we had some pretty good movement there Thursday, Friday, especially bearish. A lot of people are going to be looking at some of the lows that we did break down over the past 2 weeks. Also going to see that we are here on the SP 500 hitting, bouncing off the 100 moving average. So maybe we consolidate before we go lower, or people just look to buy the dip and go higher. I like going into short-term bonds right now with a 3 or 6 month and just keep rolling them, right? As soon as you get to expiration, collect your premium, roll into a new one. And I kind of like that approach rather than, trying to diversify, because if we go into a severe market downturn or deleveraging or anything like that, then there's not much that's going to really save you. Have hunters. Have a great weekend. Take care.